Hello, it's Jonathan Wellham of RockLinc Investment Partners, and it's December the 3rd, 2013. Today I want to talk about two issues, and both of them dealing with precious metals, and in particular, gold. The first item I want to talk about is gold as a currency and as a very good store of value over long periods of time. And there's some question about that, I think, currently in the marketplace. And as everybody knows, we keep a very strict allocation to the precious metal sector despite the ups and downs that can occur in that space from time to time. And in particular, when you think about a currency, there are 6 attributes of a good currency. And let me just list those quickly. Number 1, medium of exchange. Number 2, portable, carry it around easily. 3, durable. 4, divisible. 5, fungible or interchangeable into other currencies, you can trade. And then lastly, a store of value. And in many instances, paper currencies can be all of those if you have honest governments and you can trust what's going on in terms of the monetary conditions. But over extended periods of time, you'll find that paper currencies will not hold value as much as, say, gold or silver. And that's one of the reasons why in this environment we like to have a certain weighting in the precious metals sector despite the volatility. Now there's a chart that is going to be put up on the screen there. If you look at that closely, I think this just drives this point home to you. And in the chart you can see that it goes back to 1900 and it carries forward until the current time. So you're talking here about over 110 years. And the currencies start at 100, and that's the baseline, and gold is held constant at 100. And you can see how the paper currencies do over time. As you go along, you can see the first drop, very steep drop, and that's the Deutschmark, and that would be the hyperinflation period that hit Germany back in 1920. As you go along further, you'll come into the big drop in the yen after World War II, and the devaluation there. And in particular, if you zero in on the green line and the red line, the green line is the one that represents the pound sterling, so that's the British currency. And you can see over time, again, it's lost 95% of its value. And if you look at the red line, that's the US dollar, you can also see just an incredible loss in purchasing power. And so over periods of time, gold is an exceptionally good currency regardless of what you might hear out in the marketplace, and that's again one of the reasons why we maintain a healthy position in the gold area. The second issue that I want to talk about very quickly is the physical demand for gold. There's a lot of demand for gold. And so there's another chart that's going to go up, and in that chart there are 4 smaller charts embedded. I want to walk you through each of those in just the next couple of moments. The first chart just gives you the trajectory of the price of gold since 2003 up until just a week or so ago. So it really gives you the run of gold. We've seen gold go from about $400 up to where it is now currently around $1,200, reaching a peak of about $1,900 about 2 years ago. So you've had a steady rise in gold. The second slide that I want to just point out to you is the open interest that exists on the COMOX. And the COMOX warehouse, this whole slide that we're looking at, is dealing with the commodity exchange. And if you look at the open interest, those are the buy orders. Those are the positions that people have in gold. And much of that would be paper buy orders. In other words, people aren't necessarily buying the physical, but they're just buying pieces of paper that they hope represents the physical. The third would be how much physical gold there actually is in the COMOX. The COMOX and the exchange actually holds physical gold, and you can see that that level reached about 5 million ounces back in 2007. At the beginning of 2013, that actually had dropped to about 3 million ounces. And interestingly enough, this whole year we've seen a massive drawdown in physical gold, and that gold has been leaving the COMOX and actually going overseas, China, India, Russia. But the open interest is quite large. And so people think they have exposure to gold, but the actual physical gold is not there. And so if you go down to the last slide, this looks at how many people think they own each ounce of gold. And currently, as you go along that chart, you can see that it's gone straight up during 2013. And currently, as we look at this live, there's about 70 ounces of demand for every ounce of gold that's actually stored at the COMEX, or the Commodity Exchange. This means that if only 1.5% of the individuals who think they own the gold demanded the physical gold, you'd ultimately have a default. There's no gold there. So we look at that and we say, okay, the paper market has been weak, but the physical demand for gold by central banks, by wealthy people all around the world, continues to run at record levels. And therefore, we believe very strongly that the sell-off in gold, which is represented in the bullion, the miners, some of the royalty companies we own, is providing an unprecedented opportunity for capital growth over the next 6 to 12 months as we just literally run out of physical gold. So that's just a quick update. In that space, it's been a very volatile space, but we maintain a significant weighting, a healthy weighting in the area because of the environment that we're in and also the incredible valuations. If you have any questions, please give us a call or email. Stop by the office. Thank you very much.